We have Amy Nixon. She's an economist and housing analyst. We will get to her in just 1 second. Before we do that, it's always a good time to welcome our CEO, Stefan Rust of Truflation.com, and get a sense of the Truflation Nation and all things Truflation. Hey, Stefan, how you doing, man?
Hey, doing good, thanks. Thanks for everybody being here and overcoming some of the startup challenges with the spaces today. Um, yeah, it's a rough weekend that we've come through. So I hope nobody has any sort of relationships, or if anybody does, sorry for the pressures we're all going through at the moment, in sort of really macabre times, right? But anyway, that set aside, we're here trying to sort of move on and not give the Hamas enough attention, and focus on the matters that be around inflation and our economy. It's been a rough couple of weeks, and I think a lot more is coming to shine. The world is beginning to realize the situation that a lot of the nations are suffering with a significant amount of debt. Interest rates are rising, and as a result, it's increasing or decreasing inflation. We are seeing inflation sort of peg at about 3.5% based on the government numbers. Based on Truflation numbers, we're down at 2.6%, 2.4%. But in aggregate, over the last 3 years, your income has dropped 25%. So a quarter of your earnings is gone. So a quarter of your purchasing power has gone. You're paying an additional tax of 25%, or your salary is just decreased by 25%. All of those elements is how a lot of us feel, after a huge debasement in dollar terms. In the UK, it's even worse. In the UK, you've lost 33% of your income over the last 3 years, largely due to energy requirements. But we're seeing a lot of change. We had the PPI come out today, or coming out today. And we've got a lot of mobility issues concerning financing of housing. And, super happy to have Amy here to give us a bit more insight in terms of what's happening in the housing market. And yeah, I think people are looking for alternatives, right? And we'll see how everything goes. I think a large portion of the population are just enjoying, being able to sort of go day to day. And if they can't, then they're a bit upset about that. But there's just lots going on in the world today. A lot of changes, a lot of geopolitics having an impact on national politics, and elections coming around the corner, which is going to impact the money printer again. So there's no light at the end of the tunnel, unfortunately. We're straddled with inflation. It's going to be here for a while, especially as we start onshoring. And we are uncertain in terms of where the world's going. Until we have more clarity, I don't see any real change around what's going on. Banks are struggling with their hold to maturity positions, the losses. It's like a rewind of what we saw earlier this year. So, not too positive at the moment, but there are amazing opportunities in technology, and I just wish the government would open the windows much more and deregulate and enable and facilitate and incentivize the innovation around blockchain, around biotech, around clean tech, around AI. How can we foster these new technologies and enable innovation, fast-paced evolution of these technologies and adoption into our day-to-day lives to increase productivity, bring down unit costs, and even improve our energy allocation in terms of sourcing energy, etc. So lots of opportunity. We just need the right incentives and leadership to help us on that trajectory. But I'll stop there for a bit, and then hand it back to you, Rod.
We appreciate it, Stefan, for your opening remarks here. You are listening to Truflation Spaces. Big apologies, guys, if you clicked on the links that we've been pushing out. I'm not sure exactly what happened. I'll try to figure it out. But we're obviously on a new link now, so if you would be so kind, retweet that, re-X that, however we say it now, so that people can get in here. There was a big crowd waiting for Amy, so that is all my fault, and that's the way it goes, right? Again, you are listening to Truflation Spaces. Special guest Amy Nixon, economist and housing specialist, and we're just about to get to her. Before we do that, we always throw to our head of data, that would be Ivan Yelik, to give us kind of an update on the Truflation analysis, inflation perspective. Go right ahead, Ivan.
Hi, Rourke, and a pleasure being here again. So let's dig into what's been happening in the past month since last Spaces. And what's been happening in overall in 2023, where we have seen the interest rates are rocketing at a pace we haven't seen in decades, and yet we might be just reaching its peak. So despite this, the peak in interest rates, the inflation isn't backing down just yet, and we have mixed signals from the economy, which are actually not making the job of Fed any easier to guess what to do and what will happen with interest rates on the next FOMC meeting that's scheduled, if I'm not mistaken, November the 1st. So as of now, the Federal Reserve is choosing basically to tread lightly, holding on to a wait and see stance. And while some parts of the economy are starting to wobble and the government deficit is rising, it's likely that the central bank will keep the interest rate steady in the coming November meeting. However, the odds are still favoring another hike before we say goodbye to this year. So even though we believe the US is almost done with hiking interest rates, any easing is likely to be postponed to mid 2024 or even beyond. The robust US economy, a snug labor market, and inflation are definitely holding the Fed back from any rate cuts, even though there are some promising signs of reaching a terminal policy rate. On the other hand, even though the US has been riding this kind of wave of strong economic growth with consumer spending staying solid over the summer months, there definitely are some clouds, say like that, on the horizon, with a threat of what we've seen beginning of October, where government almost had a shutdown. We had a recent strike among the auto workers, and in October, the resumption of student loan payments has started. So that being said, on the job front, September brought a pleasant surprise with a massive addition of 336,000 jobs, which is nearly double the forecast, but we need to be careful due to the methodology that the government agency is using to forecast this. And the job market is starting to show some early signs of cooling down, as we witnessed in August. So from the government numbers and their data to what Truflation has to say, Truflation US CPI index, it's also sending some mixed signals. The index bounced back from almost reaching a 2% mark on mid-August, to 2.6 and plus closer to the end of September. But currently we are at around in the range of 2.4 to 2.5% year-over-year rate. So for the upcoming BLS report on the CPI, market expectations are much tighter than previous month, and they range from 3.5% to 3.9%, while Truflation's model predicts the inflation will dip to 3.6 in the upcoming BLS report. But nonetheless, what's happening and what we predict will happen in the next month, we are still sticking to our prediction that year-end projection for BLS is between 3.5 to 4%, and that's unfortunately still a big leap from the Fed's 2% target rate. And thing that Stefan mentioned, and which is quite interesting, is that in the past 3 years, we've seen that average Americans have lost 20+% of the purchasing power, and even more so in the UK. So what are actually the upward pressures on inflation that we see in this month, and which categories are impacted most or are impacting the inflation rate? So the main drivers of inflation are definitely the own housing, gasoline, and utilities prices. So those three categories, or those three subcategories, are the ones that are driving the inflation up, while also prices in service sectors are holding steady. And together, these drivers, we believe, are keeping the inflation well above this 2% target rate. So housing sector is definitely a mixed bag. Well, we have the prices of the own homes are climbing up due to the increased interest rates and increased prices of houses, or steady prices. The rental market, on the other hand, is cooling off, and that's one of the bigger drivers of the downward pressure on the inflation. So the high interest rates are here definitely a double-edged sword, where they're making the mortgages costlier, but are also dampening the enthusiasm in the rental market due to the overflow of available units, which means that the prices of rents are going down while the mortgages are going up. So that's in regard to housing, the subcategory of housing, the own housing, that's pushing inflation up. We have the gasoline prices, which we've seen that oil prices are fueling the inflation. A major culprit behind the current spike is the escalation of the oil prices, which are definitely jacking the cost for utilities, the gasoline, and the overall cost of living. So short term, we're not expecting any oil prices to cool off, especially with the OPEC cutting down on oil supply, and also in addition to the recent geopolitical tensions in the Middle East, which is adding fuel to the fire. One other category that is pushing the inflation up is are the energy commodities. So be it gas or oil, which are up 1.89% month over month basis. So definitely one of the bigger drivers on the inflation. Now let's focus a little bit on the categories that are pushing inflation down. And in September, we also have three main categories that contributed to the continued deflationary trend, and those are food, housing, but the downward subcategories are rents and other lodgings, but also vehicle purchases. We've seen the prices of used cars going down, new cars being stable, which definitely pushes the year-over-year rates down. So the particular interest is, as we mentioned, the mixed trend in the housing sector, which makes up nearly a quarter of the total household expenditures. And while, as mentioned, own housing is seeing inflationary pressures, the rental market is cooling as a result of excess supply coming onto the market. And In addition to that, it is quite typical for the rental sector to reflect this trend first, given the higher rotational impact of increased supply and rental agreements. But I wouldn't focus too much on the housing. I believe that Amy will have a lot more to tell about this. On the other hand, we have food category that has seen a further decline in inflation in September, down 0.46% month over month, but on a year-over-year basis, prices are still 1.05% higher, and the recent price slowdown is evident in both food at home and food away from home. One factor that's also pushing inflation down in this month is the transportation sector, but only the vehicle purchases part. And as mentioned before, both owned and new cars are pushing the inflation down. That being said, we have some other sectors like clothing and education that are pushing the prices up, but to a lesser extent. And as we gear up to the previously mentioned FOMC meeting on November 1st, the stakes are pretty high with the decision that the government has to make. Do we go with wait and see strategy and wait what's going to happen on the last meeting of this year, or we increase the interest rates? So the last month, the BLS reported a climb in CPI to 3.7%, but September is yet to be seen. And as mentioned, Truflation is predicting the drop to 3.6% year-over-year rate. Back to you, Rourke. I wouldn't go into too many details about this, but I think I managed to cover everything.
Excellent. Really appreciate it. That was Ivan Yelik, head of data at Truflation.com. As always, we publish a fully actualized graph, mathy, charty report a full day before the BLS formal print, and we get that out to subscribers and people on our email lists a full day ahead of even today. So if you want to get that analysis in print, in digital form, definitely sign up for it. And then otherwise today, we release it to the masses sometimes after the spaces, usually pretty directly. Well, that was a long way to get to our featured speaker, who's been extremely patient. I am so sorry about the link thing. I'm not. I wish I could say I knew what happened. I have no idea what happened. It's literally never. It's we've been flawless. I swear, Amy, for 6, 7 spaces in a row, and for some unknown reason, it just wanted to do it. So, in any case, without any further ado, she's an economist, probably best known for her Airbnb bust um, thesis, which she helped popularize a year ago, really this month. And Amy, thanks so much for coming on. We appreciate it.
Sure, I'm happy to be here. I do, I do want to warn that I do have a little bit under the weather, so if I'm coughing or sounding a little bit congested, then that's why. And also, don't worry about the spaces glitch. I've been on so many spaces that have glitched. It's actually quite normal for that to happen. So it can happen to anybody, big or small, and it's kind of random with just whatever's going on with Twitter. So
So
um,
weird,
yeah.
so strange. Everything went, it just went black on my phone. Anyway, that's enough of me trying to throw a pity party. So let's start then with probably what you're best known for, and then we'll get into kind of your current analysis, which is the Airbnb bust notion that you helped popularize October of last year, and it really caught fire, right? First off, what is that, and kind of what was your thinking then?
Yeah, it was kind of just a theory that I came up with, and I think a lot of people sort of just ran with the title, thinking that I was forecasting the demise of Airbnb as a company, which is not what I was doing. Although they have had a good share of PR struggles since then, but what I was referring to in that is the speculative behavior that I saw occurring with the Airbnb market, and particularly with new hosts coming in during the extremely low interest rate era. I would say it started around the frenzy started in 2020 and then it peaked in 2021, 2022 when people were we got trillions of dollars of stimulus money. We had interest rates the lowest they'd ever been. And we had this economy that was kind of bursting at the seams of having been locked down. And we had all these people who wanted to take this sort of revenge vacation after these COVID lockdowns. So there was demand for vacationers, and there was incentive for people that were flush with cash and looking at these crazy low interest rates, thinking, I got to get my money into an asset. And housing was a great asset. Real estate was a great asset for them to jump into. So they were wanting to buy rental properties, but they were also discovering, I could rent this house out for $2,000 a month to a regular family, or I could turn this into an Airbnb and I might be able to get $200 a night. And then I only have to fill the property for half the month and I can actually make more money. Or if I fill it for the entire month, then I'm going to have so much more upside in terms of revenue. And I think a lot of people then started to do this and started to talk about it on social media. There were people on TikTok, there were people on YouTube, even selling courses like, this is how you can start your first Airbnb and run it. And it felt like sort of people playing Monopoly, like trying to amass properties and run this sort of little property. They're trying to, like, they made it sound like it was this can't lose foolproof investing thesis. But in reality, what they're doing and what they are part of is a hospitality industry that's not straightforward and not easy for people that have been experienced in doing it for a long time. These are mini hotels, and you're going to have guests. You're going to have guests with complaints. You're going to have air conditioning go out. You're going to have pools need to be fixed. You're going to have people complain. You're going to have people ruin your properties. You're going to have people trash the properties. You're going to have people disrupting, being loud, and having neighbors calling and complaining. There's a lot that goes into property management that I think a lot of people just thought, oh, well, I'll just hire a property manager, or they just didn't even think about it at all. They were just thinking about the money that they might be able to generate by having this property. So when you've got a bunch of people rushing into an industry that they don't really know a lot about, and it looks like sort of like a gold rush, or this is like a gold mine, I can't lose opportunity. I think that's just sets you up for sort of the other side of that, which is the shakeout, which I refer to as the bust portion, which is what happens when a lot of these people sort of realize, hey, this is a lot harder than I thought, or hey, the economy is changing now, with the interest rate hikes, which I think nobody foresaw in 2021 that we were going to be at this Fed funds rate. Now real estate is not lucrative as an investment. It's not penciling in. If you try to pencil in a deal right now, it's not going to cash flow in most cases. So you've got people who have all these properties, and now they're starting to see a drop off in their revenue. People aren't taking as many vacations anymore. The consumer is getting squeezed by inflation. Like you guys mentioned, we're up 20%, 25% of our purchasing power has been lost in the last couple of years. And the consumer is starting to really feel that now. And then you tack on, student loan payments coming back in, and we've got jobs data that is, in my opinion, a lot weaker than it appears, because we've lost so many full-time jobs and we've replaced them with people working multiple part-time jobs. So to me, that's deflationary in consumer spending, because you're going to have a lot of people spending less money if they've lost, their full-time benefited job, and now they're working to make ends meet. So I think, and we're already starting to see it if you look at the occupancy data for a lot of the popular regions, it has peaked in most cases and is starting to come down in a lot of these regions. So in any market that's oversaturated, that had too many novice hosts come in, that market is going to be having weakness. And we're already seeing it. It's particularly Austin and Florida are two areas where you're seeing a lot of properties in the last 3 months hit the market. They are furnished. They look like they were an Airbnb. Some of them are being sold as an Airbnb. They're just buy my investment property. And some of them are just being sold, as is, buy this property. It's furnished. Those are kind of those sellers at the margin that are kind of trying to get out, because they bought these properties with debt. They did not buy these properties with cash. They took out private loans, and some of them actually have pretty high interest rates, relatively speaking. Even when the 30-year mortgage was at 3%, if you took out a private loan, you were probably getting 5 or 6%. And you need a certain amount of revenue to cover that payment. And if you're not getting it, those are the people that are going to capitulate pretty fast and start selling the property. And when you combine that with the fact that their probably utilities and definitely their homeowners insurance have doubled, if not tripled, in the last 2 years as well, then you're going to find that people are getting squeezed on these investments that they thought were kind of like a sure bet.
Yeah, it's funny, Amy. You mentioned that, right? I mean, I've been an Airbnb customer since about 2009 or something, and I've been super passionate about it ever since it launched. It was always usually cheaper than it would be a hotel. It was people actually owning maybe a second house, or they were away on vacation, and then they would let out their property. It's now so bad that I have now stopped using Airbnb. It is equal, if not more expensive sometimes, to what a hotel would charge. The check-in times are getting later and later. So I just had an Airbnb in Barcelona. It was 5 p.m. check-in time and check out at 10 a.m. So it's like, and it was more expensive than, the quality's diminished. It becomes extremely professional. It's managed by a third party that has no customer service, no respect of what you're doing, because it's all just done as an investment property and trying to get maximum yield. So they choose the cheapest management firm. They don't. They just respond in chat. So it's really deteriorated in quality and price too, and so the value's gone. And if the value's gone, can they pick that up again? Can they turn that around again?
Yeah, I think that's Brian Chesky is sort of on a mission. He's come out with, and he's been in the news a lot lately, talking about kind of the ways he's going to try to turn things around and redeem this company from kind of this bad PR that it's gotten over the last year. That it basically flipped itself on its head. It used to be the affordable, cool, fun option, and now it's not. It's expensive, and people are mad at it because
Yep.
it's, quote, ruining neighborhoods. So it's sort of gotten villainized as being something that's contributed to the housing crisis. And in no way am I saying that Airbnb in and of itself is the cause of why home prices inflated so much in the last couple of years. That Airbnb is not the number one factor at all in that.
It's a symptom, right?
Yeah, it's actually, yes, I would say it's not the disease itself. It's a symptom of the disease. The disease was the fact that we kept interest rates too low for too long. And we did that alongside pumping far too much stimulus into the economy, far more in the economy than we actually really needed during the pandemic. I think we did need to do something when the entire world was shut down and people didn't know what was going on and how deadly this disease was and what was going to happen. We needed to stimulate our economy, yes, but we did not need to keep it stimulated with those interest rates below 3, or with mortgage rates below 3% for almost all of 2021. That was a mistake, in my opinion. And that's where I think we really started to see, I think people on the ground who were paying attention saw the inflationary red flags, while the mainstream media and the Fed and everybody else was pumping out this transitory narrative.
Yeah, and I'm sorry, Stefan, go ahead.
No, it's just on that point, right? And you mentioned about revenge spending, and we've now come back from this whole revenge spend, revenge travel, etc. And you mentioned the labor market, right? And what we've noticed in the labor market are two things. One is, whilst net the labor market has increased, it hasn't increased in the private sector. It's increased in the public sector. And whilst the private sector has cut back in terms of number of open positions and in terms of retrenchment, in terms of headcount reductions or rifts in terms of, and so the government's hiring more than the private sector is laying off, so that we have a net growth in employment. I mean, and yeah, anyway, it just seems funny that that's taking place whilst just sort of those aspects. And I was just wondering, how do you see that impacting the economy? And what that impact will have? Yeah.
My take is going to probably sound incredibly cynical, but it is what it is. I don't think we would have the GDP that we have if our government wasn't spending the way that they're spending. And I don't think that, I think there's a reason that we suspended our debt ceiling when we did. And I think there's a reason that CPI is running, yeah, I'm going off the government numbers. It's running at 3.5%. And Powell's coming out and he's continually reiterating that he wants to get it back to 2%. But to be completely honest, I think that the powers that be are probably pretty happy to have inflation continue to run at 3.5%, 4%, as long as it appears to the public that they are battling it, as long as it's not running at, what I would call sort of pitchfork levels, which would be the 7 to 8% that we were hitting, a year or so ago. That is a problem because that causes social unrest. But when you've got inflation, in this sort of 3-ish% range, it's uncomfortable and people don't like it. And Powell said that at Jackson Hole. He said people hate inflation. But you know who doesn't hate inflation? Are governments that have way too much debt. So, in my opinion, I'm sort of stepping back here, zooming way out. I'm making the argument that it is possible that what's going on here is that the government is actually okay with letting inflation run slightly warm. They don't want it hot because that's going to hurt them in the elections. But to let it run just a little bit above that 2% target. And there's actually been, I think a Harvard guy came out and wrote an op-ed about this, and it caused a lot of upheaval. I think it's a couple months ago, basically arguing that we should just accept a 3 to 4% inflation level. Like, that wouldn't be a bad thing. Like, why don't we just do that? I think the reason why we don't publicly do that is because the public perception of that is not going to be favorable. But in terms of how our country's balance sheet looks and what we're dealing with, I think the government would actually be perfectly okay with inflation running around the 3-ish% level for a while, as long as they can get away with that for as long as something in the economy doesn't break. And I think that's kind of where we're at right now. And that's where we've been at for a couple months now. So it's going to be interesting to see how that looks going forward, with, especially now that we've got introduced geopolitical tensions to this whole mix. And also on the subject of inflation, I do want to mention, because I think people talk about this a lot, but they don't actually specify. There has been a few key changes to the way that we calculate the official numbers, not your numbers. The official numbers have been calculated for inflation since the 80s during the, quote, Volcker era. And I think the two biggest ones that have the most impact are, number one, housing. We used to include home prices, and in the 80s, we pivoted to what's called owner's equivalent rent, which in our current situation means that the official government inflation numbers are reflecting lower. If we used home prices themselves, our official inflation numbers would be reading higher right now, because rents did not climb as much as home prices during the last 3 years. They climbed a lot, but they did not climb quite as much. And rents are now starting to come down a little bit more quickly than home prices as well. So that is one area where I think inflation is actually really, in terms of how the consumer feels it, slightly higher than what the even official government number says. And the other change that's been made, I think it was made in the late 90s, was that they introduced CPI with product substitutions, meaning if you were a person who went to the grocery store and bought beef, but it became too expensive to buy beef, you would buy chicken instead. And so they decided, well, I think most people are probably going to just buy the chicken. So they introduced this thing called substitutions, where they would use the substituted item to calculate the inflation instead of using the beef or the former item. And once again, this is another change that's going to result in what appears to be a lower inflation number, but it doesn't feel that way to the consumer, because what that feels like to the consumer is downward mobility. That feels like a standard of living dropped a notch. People don't go to the grocery store and say, "Oh, I wanted to buy this beef, but now I'm buying this chicken because it's cheaper and I can't afford the beef." They don't go home and feel good about that. Maybe on the official CPI number, it shows that it's not as high as it was, but to your brain, you feel like you've lost something, or you've lost purchasing power, or you are not getting what you really wanted, or the thing that you wanted costs too much. So that's another change since how we calculate CPI since the Volcker era that I think is really impactful on the way that the consumer feels it, but it shows a number, an official number that's slightly lower than probably what the consumer is feeling. And again, zooming way back out too, the consumer always feels the aggregate. So we may only be running, a tiny pinpoint of a percentage higher in inflation this month versus last month versus the prior month. But when you go to the grocery store, you feel that 20% over 2 years ago. That's what your budget feels when you're looking at prices. And again, this is all inflation. This is not deflation. So the prices are still higher and climbing higher.
And that's exactly why we also, because of that feedback from the community on our website, we actually had to paint a picture of how you are actually being impacted, right? Whilst inflation may be down at 2.6% according to Truflation, we just were hearing that's not true. It can't be. It's been going up. The prices are 20-30% more than it was 2-3 years ago. And so we did an aggregated view, and now everybody seems to be resonating with the fact that it's now 25% more than it was 2 years ago or 3 years ago. So it's been, yeah, just amazing how that small little change has yeah. And we won't go back to 2%, to your point earlier. There's no way we're going to hit 2% with all the geopolitical issues going on, supply chain changes, onshoring of manufacturing, the cost of capital to invest and develop and build out the onshore manufacturing capability. I mean, those are all going to cost money, subsidies, tax breaks, etc. Um, and not to mention the different types of taxing that's been coming our way. The government, the IRS, hiring 87,000 new people to help claim and go and collect more taxes from individuals and the middle class that has been working, yeah, they're really hard to keep the economy going and not collapsing during this whole COVID time and the recovery out of COVID.
You're listening to Truflation Spaces. Special guest Amy Nixon. She's an economist and housing analyst who's best known for Airbnb Bust uh, thesis, and we're fleshing it out today here just for you. As always, we want your comments, your questions for Amy. You can just add us in here, request to speak, and I'll try to get you on. I must warn you, I'm a little gun shy to touch my screen. Because the last time I did that, I worked the entire spaces. So if you're wondering why this link is where it is. That's why, guys. So if I don't get you in right away, just realize it's because I'm scared. Looking at the mortgage rates this morning, 30-year fixed at 8.4%. Just this week, we published the housing industry's note to Powell. Builders and mortgage brokers and all these people, they're basically saying, hey, cool it. We think you've broken the housing market. Amy, you've kind of touched on where we are today, but it seems like that letter from the housing industry is a bit unprecedented. Do you remember them ever writing the Fed or a chairperson to ask, to cool it out?
No, I mean, I was uh, during the Volcker era. I would not have, I would not be able to weigh in on that as before my time. But I do hear that there were very angry people. There were perhaps death threats even against Volcker when he was hiking interest rates to like 15, 16%. But I don't know that there was anything in terms of like an official letter from these
Oh, I'm
different
sorry.
organizations.
I'm sorry. I might have misspoke. I may have Volcker on the mind here. I meant Powell. Just this week, the homeowners, it's like the builders. There was a letter that went out to Jay Powell from the U.S. Housing, the different lobbyists and groups telling Powell and the Fed to stop hiking rates and so on. Did you get a chance to see that this week?
Yes, I did. I was just referring back to if you had asked if it was unprecedented, and I said
Oh, got it.
I don't know if it happened. I know that there was a lot of anger during the Volcker era, but I don't think we've ever gotten an official letter like this before. And I think, yeah, I read the letter, and um, I understand why they wrote it, because to a certain extent, there are people in all of these industries, in mortgage organization, in real estate agents, people whose entire business, their livelihood depends on a functioning market, and a market that is operational. And what we basically have had for the last year and a half is a housing recession, in the sense of housing market activity has been in a recession. We are not having the transaction levels that are they're rock bottom transaction levels. The transactions that are occurring are being done with builders at rates that are undercutting what the Fed's rate, or what the 30-year mortgage rate is, because they're buying rates down, and they're cash transactions. Those are the types of transactions that have been really happening in this market over the last year and a half. So anybody that works in these industries is simply not getting business. And there's a lot of good, honest people in all of these industries that don't, it's not, quote, fair to them. They don't know what to do. And obviously you can make the argument, well, you guys had a windfall in 2020 and 2021 where you were turning away business. My husband and I were looking at doing new construction in 2021. We couldn't get a builder to return our phone call. We were placed on a wait list. I think we were 321st on a wait list to get a new construction home. So that was sort of the other side of it. And back then, were people complaining when the money was good and when things were in their favor? No, there were no letters, there were no complaints. There actually were some real estate agents back then that I spoke to that were very frustrated with the market then, because they had buyers getting outbid right and left, and they hated it. They wanted a normal, quote, normal real estate market, and we didn't get that. But yeah, I think it's in bad form for them to write this letter, because it's just it's a bad look. I mean, they sound like, hey, we got the benefits from the low rates, but now we're not willing to pay any of the price on the back end with what we have to do to offset what that did to distort our market.
That's really, really fascinating. And in classical economics, it's called malinvestment, where you get all this loose credit, this frosty or frothy this frothy money just kind of sloshing about, and people seem to consider their industries booming as economically viable, when, as you say, they're probably a product of ZERP or something close to that. So when the reckoning comes, it is interesting to kind of see it work itself full circle here. Our head of data, Ivan Yelik, has a question. Sorry, Ivan, go right ahead.
Thank you. Yeah, it's just on the current situation, and current quarter just ended. So we enter the final quarter of the year, which is usually, historically, it's a slower one. Do you see anything differently happening this Q4 of 2023? Do you think it'll be different, more activity, or it will be more quiet as people are starting to prepare and focus more on the family, on the holiday season? And also adding up to the mix is the remote work that is definitely reshaping the housing demands. And we are also still, as mentioned, dealing with supply chain issues affecting new home construction. So the question is basically, do you see this upcoming quarter being just one Q4 in a row, or this one will be potentially something different due to the situation in the market?
That's a good question. We're actually seeing a little bit of unusual activity with inventory rising this late in the season is not typical, and it is actually rising at a faster pace than it was this year or this time last year. So I do think that the mortgage rates breaching 8% is going to have a little bit more of an impact than prior quarters. I think that combined with sort of some of the softening we're seeing in the labor market is going to just put a little bit more pressure on housing. I know last year in Q4, home prices started to turn down a little bit in several parts of the country. And I think we're going to see that again in this Q4, possibly to an even stronger extent in regions that already have a lot of inventory. And Austin is the example I use most often because Austin's already back to 2019 inventory levels. So any part of the country where you've got both new construction going on and existing inventory climbing sort of back to those pre-pandemic levels, those are going to be regions where you're going to be at high risk for price correction. I think that we're going to start to see sort of those quote pandemic hotspot regions are showing they've been showing weakness. They're going to continue to show weakness in Q4, going into 2024. Basically just based on the fact that inventory is starting to climb in some of those areas. And that's really been the main thing propping prices up so far. It's not been demand, it's been low inventory. And demand now with an 8% 30-year is going to be even worse than it's been, which has already been near record lows for the last several quarters. So I think we're just sort of, it's like, I think it's kind of been surprising to me because I think the Fed probably expected that housing was going to respond earlier to these high interest rates, but there's just been too many other inflationary pieces of the puzzle, like just the extra stimulus money still working its way through the economy, and the fact that a lot of people just sort of swapping houses, like it's been an asset trade where somebody from a more expensive region of the country sells their home for cash and then buys in a less expensive region. And then you had the builders also operating on their own interest rate environment where they're basically buying rates down to 5%. They're saying we reject the Fed's rate. We're going to do it on our own terms. So that's kind of what's been going on for the last year and a half. But I think that that's starting to run its course. That's starting to run out of steam. And the longer that the Fed holds these rates, the less that those tactics are going to work. And the more that the true market and true price discovery are going to start to come forth. And so I do think that we're going to see home prices start to drop more in the pandemic hot regions in the next several months. And then as far as the entire country, it's going to take longer to see how that's going to shake out. And there's probably honestly going to be some regions that don't necessarily even have price corrections. Because again, this was a very regional pandemic market and the prices didn't go up in the same way in all the regions, and they're not going to come down in the same way in all the regions either.
You're listening to Truflation Spaces. It's our CPI, our annual monthly CPI call with special guest Amy Nixon, an economist and housing analyst. She's been a real trooper here. I know she's been under the weather. And then we had the mix up with the links. So I really appreciate all of her time. Maybe the final question is, we've been kind of black-pilled the whole hour here, but is I guess a provocative question: is the American dream dead? The idea of owning your first home and the picket fence and the 2.5 kids, is that something that we maybe have to adjust to a new normal? Do you think, Amy?
You know, I think it died in 2008 with the way that they responded to that housing crisis. That's when we saw just enormous amounts of private equity money start to come into the housing market. That's who bought the foreclosed homes from the quote everyday Americans. In the wake of that crisis, private equity swept in and started buying cheap homes, and they bought them from 2009 to 2012 for really, really low prices. And once they sort of got a foothold in that market and understood how the asset could be used to produce the yield that they wanted it started to be something that was put into ETFs. It started to be something that was put into pension fund money started to go into it. And we're seeing today, even now, I can already see it around me. There is capital. There's war chests of capital of private equity money being built right now. I think in expectation of the possibility that we have another deflationary crisis or credit event and these asset prices come down once again, I think that we're going to see another wave of private equity money come in and buy residential housing again, unless we do something to regulate it. That's just inevitable to me, because that's just what happens with assets that produce yield. We're moving in that direction in every way possible. Even with banking, we're seeing smaller banks getting swallowed up by bigger banks. We've seen it in retail. We're seeing Amazon sort of swallow up your mom and pop local shop. We're kind of moving towards this consolidation of power almost in these big money holder private equity institutions. And unfortunately, I don't see anything that's going to derail that for the average person, especially when you look at the younger generations, how they're situated going into this. I mean, they're many of them saddled with enormous amounts of student debt. They don't own assets. They don't have money yet in the stock market. There's just no way for them to get ahead or to even catch up in a lot of ways. So I just don't see any way that this trajectory can change.
Wow. We wanted it straight, no chaser. We got it straight, no chaser. There's no Disneyland ending here. It's amazing because we can get kind of medicinal and just kind of talking about housing and numbers and markets, but there's a social cohesion mechanism to this. There's kind of a way of looking at what would be thought of as the middle class typically, and it all kind of flows from these abstract numbers and the slowing the rate of increase ideas and inflation. It all kind of comes together to create this really interesting picture. Um, Last thought, I guess, even though I lied and said that was the final question. I think boomers are going to be poor Amy. Boomers are going to be obviously transitioning into the next whatever your religious beliefs are. They're going to be leaving us, and I think they're going to leave a lot of property to their Gen X kids. Maybe that's in a macabre way. Maybe that's a way into housing, Amy.
Yeah, and I think that's going to really sort of change the landscape of our country for the first time, I think, in hundreds of years, to a situation where more than ever it's going to matter for these younger generations who your parents were and what your parents owned. And it's not been that way in our country for so many years. We've had upward mobility with younger generations, where younger generations earned more and did better and went beyond what their parents were able to do. And this is the first, millennials are actually the first generation where they're lagging. And I think with Gen Z, we're going to see even more, where if you were lucky enough to be born to parents who lived in California and had a house that is now worth a couple $1,000,000, then you get to inherit that house, versus if you weren't lucky to be born to parents who owned a home. And it scares me, honestly, for future generations, because I think that when you have an entire generation of people for whom a lot of them inherit or did not work for the things that they have, and then you have their peers who are working hard and realizing that they're not able and they're not going to be able to have those same things, there's going to be a lot of social unrest sort of between those haves and have nots, especially if it feels like that ladder has been pulled up from them and the ones who are the have nots cannot find a way to get up. So that is very concerning to me. That's something I think that will be new in our future that we haven't really faced before, because for a long time the American dream has sort of been alive and it's been an option on the table. Even if you were born into the poorest family, there was a path and a way forward, and that path has narrowed so much. And I think that when the boomers begin to pass away and their properties get sold off, there's going to be sort of these have and have not groups. And I think even amongst the have and have not groups, a lot of these people are going to inherit a home, maybe 3 siblings. They're going to immediately turn around and sell it to private equity because they can't afford to even pay the taxes on it or maintain it or be able to deal with renting out the property. So it's not going to be a pretty transition, I don't think.
Do you think that you mentioned Austin earlier, right? I mean, do you think that people are moving from California to Austin or Nashville or other states, maybe more in the Denver has been seeing a boom, that they're taking their sort of earned money from major cities, San Francisco, New York, and then moving into the I was just talking to somebody, they moved from New York to Tucson, right? So people are sort of moving into maybe more the Midwest where real estate's a bit cheaper to be able to afford a house and thereby get on the ladder. But you are already, late 30s, sort of, or early 40s when you're starting to purchase that house.
Yeah, that's definitely been happening over the past 3 to 4 years. But again, I think that's going to run into a wall eventually too of just how long that's going to work for and the affordability levels of a lot of these. Like I live in Dallas. We're not affordable anymore. We used to be considered an affordable region, but our home prices have gone up over 100% in the last 3 years, and our property taxes in a lot of our suburbs are 2.5%. So if you take our home prices and you
Yeah.
take them from $400,000 to $800,000, that person buying an $800,000 house is paying 20 grand a year in taxes.
Yeah.
So yeah, we've created in a lot of these regions, like you mentioned, Austin, Nashville, Dallas, we've created a new price floor that's higher because of these remote workers that have come in with higher salaries. So I think prices aren't ever going back to what they were, in 2015, 2016. No, they're not, because we do have a new price floor. But I also think there's going to be a ceiling, and we're probably going to hit it pretty soon, just in terms of affordability is going to be so out of whack that even some of these people from other regions are going to do the math and say, hey, you know what? It's not worth it for me. I have to pay this much in property taxes, and I have to live in this place that's inferior in XYZ way to the one I'm leaving. Then they're going to start to run it and be like, I'm just going to stay where I am, or I'm going to try to find a different place. Like you said, the Midwest. I mean, eventually we're going to tap out of the affordable markets and they're all going to become unaffordable. So that only works to a certain extent before that card is played and burned out as well. So yeah, and then you start looking overseas. We're hearing of that now too, where people are like, I'm going to move to Costa Rica, or I'm going to move to Portugal. Yeah, that's the level that we're at right now, which is kind of crazy. It's like we're exporting our problems now to other countries.
Yeah, I
Wow.
just met 2 people that have moved from